why we have picked the topic is once Dr. C.N. Manjunath, our cardiologist, told in one of our meeting, it pains me so much when a doctor asks for a discount in the bill in the cardiology in this thing. Not all doctors are rich. Not that doctors work and make money, but the doctors don't know how to manage money. That is a very important thing. As we see, either because of one reason or the other, at the time of retirement, they will not have enough money to survive. That is one of the reasons. And many more things, Dr. Our guest speaker will be speaking. Without wasting much time, I will go on for I.M.A. prayer. We shall start the meeting with I.M.A. prayer. May everybody be happy. May everybody be healthy. May everybody be free from pain. May everybody be free from sorrow. May we be healing cure beyond every greed and lure. So once again, I welcome our State President, Dr. Srinivasa, and so also our guest speaker, Dr. Shirish Narsapur. And I request our President, Dr. Srinivasa, to inaugurate this webinar.
So good evening, everyone. I think I have to appreciate Dr. Rajendra Prasad. So, and arranging this type of
request
new topic, but definitely whatever you told is 100% true. Doctors are very, very bad in money calculations and money lending, all these aspects. So I think Dr. S. M. Prasad also, he arranged some program last few months back when he was the president of IIP Bangalore. He knows everything about that. So here, so many people are there. Nandish, very senior I.M.A. member from Mandya. So he's there. Actually, he's very tactful and money management, I think he know better than us. Definitely he will tell. And so many are there, our friends here. So Krishnamurthy and so many aspects, Dr. Shobha, everybody is there definitely. So officially, I'm going to inaugurate this program with good wishes to our program and with a lot of this one to Dr. Rajendra Prasad, Nelamangala team, and definitely everybody will enjoy and everybody learn little more aspect about this. So I thank you for again, once again I thank him and I welcome everyone, those who are there here. Thank you. You can start the program, sir.
Thank you, sir. Thank you very much.
Yeah.
And our guest speaker, Dr. Shirish M. Narsapur, has given very, very brief introduction of his. He is a consultant orthopedic surgeon and arthroscopy surgeon, currently working as a freelance in 3 cities across 3 countries. And I think more he will be introducing himself during the course of his talk. I request Dr. Shirish Narsapur to take over and start with the presentation. Thank you, sir. Thank you very much.
Namaskara. Ellarigu namaskara. Thank you. Thank you.
I request everybody to mute and raise a hand when they want to ask question.
Thank you, sir. Thank you. Ellarigu namaskara. Nan Dr. Shirish Narsapur anta. I'll stick to English. I'm an orthopedic surgeon, currently working as a freelance, and purposefully I had requested sir to give that kind of a specific intro, saying that I'm working on my own time, and which is what most of the doctors want to, but it's becoming very difficult because we are not adept at finances. And let us accept the fact that we are not adept at finances. Quite a few of us are into investing, and we have a big capital, but lot of us, a majority chunk are not that say financially rich or sound, and they do not even know how to manage the money. 3 years ago, I was in the same state. Because of that only, I was forced to leave my family, go to the other country to earn, and keep struggling with the corporate bosses, and sometimes get irritated. So all these things were happening. But when I was exposed to financial education, which was a prime thing for the doctors, started by Dr. Ramnath Gute through his brand called WealthCon, wherein financial education is taught only to doctors and only by doctors. There are no other doctors which are entertained. Only MBBS and post-MBBS doctors are entertained in this. So my aim today in this talk would be to take you through the nuances of passive investing, so that you can keep earning actively as well as work for your passion, and keep generating passive income, which will help you in achieving your financial goals as early as possible. So I'll just start to share my presentation. I hope my screen is clear and my voice is audible. As a customary thing in WealthCon, we always begin with a thank you slide. First of all, by saying thank you because you have provided me the opportunity to share my knowledge and hopefully increase yours by the time this presentation ends. And also to thank you all for coming and attending this during your busy schedule. 8:30 is one of the prime times during the OPD also. So,
recording in progress.
So, as with any paper which we write, there will always be some aims and objectives. So the aims for this seminar is to give knowledge for all of the doctors to start passive investment and create wealth, to provide the financial education. We are not going to give you any tips of shares or mutual funds that you have to buy this or buy that, and absolutely no discussion on cash generation or cryptocurrencies, which are unregulated. Whatever knowledge we are here sharing, it's whatever is suiting to you, it is better to accept it, just like a swan, which when provided with the water and milk choice goes with milk and rejects the water. So similar to that, whatever knowledge applies to you, please take it in, and if you can apply it, well and good. Otherwise, nobody is going to hold any grudge against anybody. So as I mentioned, this WealthCon was started by our eminent radiologist in Bombay, Dr. Ramnath Gute, and over a period of the last 7 years, he has already taught more than 50,000 doctors actively, many of whom, like almost 10,000 of us, we are doing active trading as well. That is futures and options trading. The idea is not to make the traders out of the doctors, which will be the worst kind of thing. The idea is to give an additional weapon for earning from the active income. Anyway, what you're getting, you're earning, but with a passive income, that stress of earning reduces a lot. So what exactly do we mean by financial freedom? Just to put it in this way, what is retirement? Is retirement by 60 years or 65 years or 70 years? Is that age limit which is going to be considered as retirement, or what? Question answers we can take at the end, but the idea what we are proposing is retirement means cessation of financial worries. You can continue to work for your passion, whatever. Many of us are orthopedic surgeons, many of us are general surgeons or physicians or pediatricians. You can continue to work for your passion without having to worry about the earning. That is financial freedom, and that is actual retirement. Because even if you reach the age of, say, actual retirement of 60 and still you have worries of finances, you are not actually retired. Second thing is, if you do not have any overheads on yourself, that is no loans. If you're loan free and if you are financially free, you have achieved your retirement. That does not mean that you can stop working. Now this slide, you can see here that 5% and 95%. Now 95% of the people have only 5% of the wealth, but the 95% of wealth is there only in the 5% of the people. Now, why is there a big divide? We say that our country is capitalist, and we see that a lot of people are blaming our economy, that it is capitalist economy, and rich people are getting richer and poor people are getting poorer. It is not because the poor people are not earning. It is because the rich people have applied their knowledge and managed their finances well. And because of the fact of compounding, which is the eighth wonder of the world, compounding creates more wealth. The more wealth you have, the more wealth it creates. So that is the magic of compounding. That is why wealthier people get wealthier. They keep getting wealthier because of compounding. We'll be discussing that also further. So certain things which we are going to be touching today is what is wealth, what is income, assets, liabilities, inflation, time value of money, and compounding effect, what I just mentioned you. The aim of this seminar is to create assets. Now, what do you define? What do you mean by asset? Asset is anything which gives you money, which is opposite of that of the liabilities. Liabilities means as long as you own those, that is going to keep on taking money because it needs frequent addressing and frequent spending for it to be maintained in that way. But asset is something which will create more money. It will increase in value over time. Now, for the financial assets, we have divided that into this these four assets. That is GRED. G is gold, R is real estate, D is debt, and E is equity. So the earning from these happen because of capital gain, that is appreciation in the price, or by rent or interest, or by dividend incomes. Okay, so this is how the value of these things keep on increasing. Now, the difference between equity and debt is that equity, the value of the asset keeps going up, coming down, going up, coming down, but in the long term, it will always be going up. When you look at a picture of say 7 years, you will never see that equity has given negative returns. 1 or 2 years short term, it may give negative, but it generally recovers and recovers swiftly. Debt means it gives you a sustained returns. Like year on year, it is going to give you the same returns, that is 6% or 7% or whatever is your thing. So all the examples of say fixed deposits or your post office deposits, they go into the debt category. They go into the category of debt. Sorry. Yes. And all the investment like mutual funds or shares, they go into the equity category. Gold, now we have different types of investment for gold as well. Traditionally, the gold has always been in the form of jewelry, but now we have multiple options, which I'm going to discuss further. Without wasting time, let me move to the next slide to show what is an asset. Now, what is income and what is wealth? Income is something which you get every month for your work, either active or passive. Passive means by either investing into the shares or mutual funds or in the real estate, or from your copyrights, whatever you have. If you have published something and for the copyrights, you're getting royalties. All this goes into income. Now, as the income comes in, the more the chunk of finance that it creates over a period of time is called as the wealth. Now, wealth is created only by the means of investment. If the income keeps coming and if it starts to be, it starts to go out, it starts to leak out, then there is no wealth creation happening. But as soon as the tap is closed and the income keeps coming in, it grows by leaps and bounds, and that is how the wealth is created. The wealth was never created overnight. Nowadays, we are seeing that a lot of us doctors are being scammed with the possibility of, with the lure of 30% gains in 1 month. And they fall for it and they start losing crores and crores. And we've seen that, very, very shocking to say, and very sorry to hear that one of our IMA members also, he lost 3.5 crores, and another doctor who lost 8 crores in Hyderabad. So all these things, and there is a reason why these people are targeting doctors, because let's accept the fact that we are financially illiterate. We may be having lots of degrees, but we are financially illiterate. So it is time to become literate and take control of our own finances. So the wealth can be created by either building up your business or by real estate or by becoming an investor. Now, many of us may be having big hospitals, which is giving you year on year, month on month profits. That is fine. But a major chunk of us, we are working either in other hospitals or running private clinics, small clinics, which are small scale and which do not have the capacity to generate as much revenue as a big hospital does. It will take time for the business to build. But what you can do right now is build your portfolio, become an investor in the equity market, become an investor. Today, I'm not going to teach you what all shares or what all mutual funds you can invest in, but I'm going to give you a fair bit of an idea. And in the end, when we are going to discuss more in question answer sessions, definitely I'm going to touch all these topics. Secondly, it is very common that most of these life insurance agents, I'm not going to name any companies, but you all are aware which company I'm talking about. But all these life insurance agents, they come with endowment policies to the doctors saying, you buy this policy and by the time you are, they say, we're going to cover your life for 10 lakh, 20 lakh or whatever lakhs. And then you keep paying hefty premiums and you'll get your money back at the end of so many years. Let us accept the fact that by buying policies or plans or schemes, nobody has ever become rich. Okay, so if we are having the policies or anything, it is time to close them. I have closed all my LIC policies, all my life insurance policies from other companies like Reliance as well as I've closed. I'll be discussing what is to be taken and then what all plans to be closed. Why do we need financial education as doctors? Because already doctors, we are the cream of the society. But as Sir opened it up saying that it pains to see that the doctor is asking for discount for a treatment. That is just one part. We have to deal with a lot many things. Like the main thing which are dealing on an everyday basis is the inflation, the lifestyle expectations, and our own personal ambitions and personal aspirations, that we need to have so many things saved for our kids' education, or we want to build a house, or you want to roam around the world. So many aspirations are there. But this can be possible only if you are financially well educated to know where and how you can utilize your money well and how it will not pinch your pocket as well. The idea of today's discussion is to change our beliefs and change our attitudes towards finance. Change our beliefs, because for so long we have believed that those people who are managing our portfolio for us or managing our finances for us are having our interest in their mind. No, they are having their own interests in their mind. Remember, there is no free lunch in the world. Only scammers and only people who are going to make money from you are going to come to your door themselves. But the control, you have to take it yourself. The biggest myth for money is they say that the money is not important, that money is the root cause of evil, money doesn't buy happiness, all these things. All those who say that money is not important or money doesn't buy you happiness, you can make those statements provided you have $1 billion in your account. So money is important. Whoever says that money is not important is either a fool or is just lying around. Money is important for everything. We know whatever we do, we need money to buy, to do anything, you need money. Money is not the root cause of evil. Money used in a wrong way definitely is the cause of evil. So that is why we are not teaching cash generations. We are actually teaching how to generate more white money. And be happy that you are one amongst those creamy layer who are paying taxes. The tax is only paid when we have income. So generate more money, get more income, pay more tax, that's fine. And it has been fed to us by all these agents who come to our door and saying that, doctor, I will manage your finances. You are quite busy. Let me handle your finances. I'm going to only charge you this many percent finance. Then you start to feel, okay, finance is difficult and it is not my cup of tea. But finance is actually a 7th grade subject. It needs to be taught in the school. It's a 7th grade subject. We in WealthCon have a group of 7th, 8th, and 9th standard kids who are discussing actively in finance. And let me tell you, some of them are brighter than the brightest of the doctors right now we have in our group, and they have much more knowledge than what we have. So if someone comes and tells you, doctor, you are busy, he is actually not praising you. Consider that he is actually scolding you. He is calling you names. He is making fun of you. Now the question comes, what is money? Money, is it something physical? Because now, especially after the demonetization has happened, I have hardly taken out the cash from the ATM and used it. Most of the times it has been an online payment using UPI or credit card. So where is the money? I'm not physically exchanging anything. So imagine, so whenever salary is credited to your account, or whatever is credited, it is just a ledger entry. So basically money is just a ledger entry. There are not enough notes to back the entire currency which is there in circulation digitally. So basically, the banks are creating the money. So this is the money supply, which you can see has happened over a period of time from 2014 to say 2022. So from 80,000 trillion rupees, okay, so this is in trillion rupees, so this is 80,000 trillion to 24,000 trillion. So where has this money come from? How does this money get generated? This happens because the GDP is rising. And right now, India is looking to be the third largest economy in the world by 2027. Right now, we are 5th. And at this rate, we are going to be the third largest economy. So this is the golden time to invest in the idea of India. Now, I'm not going to go into detail of how the RBI creates money because that is not the agenda for today's discussion. Today's discussion is financial education. So we are going to divide that into 7 small topics: earning, saving, spending, investing, tax, insurance, and loan. Tax also we are not going to discuss in detail because our taxes are handled by our CS. It is better that our taxes are handled by them. But yes, of course, there are a lot many things which we should be knowing because many of the CS also do not know entire things about the tax. Earning, as you know, active and passive. Active income is through salary or your professional fees. There is no special mention about what an active income is going to be for most of the doctors. Okay. Passive income is either by investing or by if you have any real estate property, you give it on rent, you're getting the rental on a monthly basis, or you have some deposits on which you're getting an interest, or you provided some loan on which you're taking an interest. You have investment in shares which are giving you dividends and capital gains. So these are all passive incomes. What the difference between active and passive income is the name itself. Active means to get that income, you have to spend your active energy and time. But passive income is something which you once put it, automatically that money generates more money for you. So that is passive income. So after the earning comes spending. Now, most often we are thinking that, okay, whatever we have earned, we'll start splurging on ourselves and start spending. We are not trying to make you a total spiritual and non-materialistic person here, but yes, there is a difference between what products we are purchasing and for what reason we are doing it. So we have divided those products into products of needs and products of prestige. The products of needs are everyday requirements like food, water, shelter, or your basic bikes or basic cars, which will help you move from point A to point B or whatever it is, like for daily thing. Now, products of prestige is something which are quite expensive and actually needless. They just try to show your status in the society, which are of course, which of course comes at a lot of cost, and which does not, the value of which keeps going down over a period of time. This is a simple test. It's called as a Facebook or party test. So whatever product you're taking and you're putting it on your WhatsApp or on Facebook as a photograph saying, I bought this. So those things are products of prestige. And those things which are not, those are products of needs. Because products of needs, nobody is going to put it on Facebook. So after the earning and spending comes investment. Now there are two ways to invest. One is systematic investment plan, which is called as monthly investment. That monthly you're removing so much of money and you're investing. And there is something called as a lump sum. That is, you invest at once when you have a lot of corpus. Now, the difference between the investment is again of two types. One is you do the investment by yourself, which is called as direct investment, and one is some via agents or friends, which is called as a regular investment. I mean, which does not have any, we will discuss about that also. This we have already discussed what is asset. Now there should be this slide is called diversification also. Now diversification means don't put all your eggs in the same basket. Now if the basket goes, all your eggs go. So there should be an adequate diversification, because what happens is the equity, the gold and the real estate, the prices, they keep shifting up and down, up and down. There is no one particular path that the price follows, but in the long term, all equity as well as gold as well as real estate are looking to go up only. Even debt goes up, but it's a slow race. Like it's very slow. So this is the chart which shows how the prices move in equity or gold or in debt. Now you can see the price started from here. For this one, I'll just annotate here. You can see that the price started here. It is moving up and down, 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 up and down. But in the long-term trend, you can see that the price is going up. There may be few scary dips like this. This is the COVID time. Okay, this is during the COVID time when there was a sudden market crash. There was a lot of panic around. But even then, COVID happened. This happened swiftly within a span of say 1 month. But after that, within the next 8 months, the market recovered back to its original level and has looked to go okay. The debt, on the other hand, is a smooth line going up. Okay, so debt keeps on going at its own pace, but equity keeps going up and down, and there was sometimes there is a sudden jump, there is a crash, there is jump, but long term, it's always looking up. This is the situation of our Indian market. Why do we diversify between equity and gold? Now you can see the chart here. This is the chart. The top chart is that of equity. This is equity and this is gold. Now you can see that sometimes when equity has crashed, at that time, same time, you can see that the gold has appreciated, gone up here. Okay. Again, when the market is going up, the gold is coming. Gold has come down. So the gold and the market many times have an inverse relationship. When the market is going up, the gold is falling, or when the market is falling, the gold is going up. What this does is, if you have adequate in gold and nifty, it balances your portfolio. Like if I put entire 100% in equity or 100% in gold, I don't, if the rates go down, I have to see the loss. If the rates go up, I see the profit. But when I diversify between the gold and the equity, because of these inverse relationships, my portfolio remains balanced. So even if there is a loss in one segment, the profit in the other segment takes care of it. So I don't have to worry about any huge losses. as I was discussing, that there are multiple avenues for this investing in gold. Previously, it used to be just in jewelry, but jewelry carries a lot of problems like wastage and making charge and whatnot. I mean, for example, like if I take jewelry from one company and try to sell it to other, they will charge you 4% or 5% in wastage, which is a huge loss. Plus, jewelry, what are you going to do? You're just going to keep it in the bank locker. You're not going to be using it anyway for investment. It's just an unrealized gain. Like you have a jewelry, it's there in the locker and it is appreciating so much. You're not utilizing it at all. There are other avenues of investment in gold, in equity as well. For example, in the sovereign gold bonds, which currently are in a tricky phase, maybe the government may not come up with the new tranche of SGBs, but still the existing tranche will be available for you to buy. And there's something called as gold bees. Gold bees is like buying 1 gram of gold, 18 karat. 1 gram of 18 karat gold. It is backed by gold prices. So if the gold price goes up, the price of gold bees goes up. If the gold price goes down, the price of gold bees goes down. It is backed by physical gold from RBI. So the gold bees is like directly investing in gold. Now the advantage of that is that there are no making charges, there is no wastage. So absolutely every gain in the price of gold is a gain in your gold bees without having to worry about any sort of wastage. This is in equity. I think this is also, this should be 30, this should be 20% or 30%. So the gold bees is also an equity. It comes under the capital gains. So 20%. Now with the indexation removed, this is gone. 20% is 12.5% is your long-term capital gains and 20% is your short-term capital gains across all asset class. So to avoid the extra expenses on jewelry, it is better to invest in SGBs and gold bees. Now the debt products, there are multiple debt products which are like the public provident fund or fixed deposit, liquid bees, liquid funds, arbitrage funds, etc., government securities as well. Now, the difference between equity and gold, I can provide you a very good analogy here, is that, see, for example, there are two modes of transport. One is an aeroplane, the other is the scooter, humble scooter. Now consider that you want to go from Bangalore to USA. You are not going to use scooter. You are going to use an aeroplane. But if you want to go from, say, your house to the local market to purchase some vegetables or something, at that time, you are not going to use an aeroplane. You are going to use your humble scooter. The analogy I'm providing of a scooter and an aeroplane here is that aeroplane is for equity and scooter is for debt. Debt funds means short-term money parking. In debt funds, you're not going to lose your capital. So short-term, if you're looking to park your money for the short term, then debt funds are the best investing products because it will appreciate at 5% or 6%, whatever is the rate fixed by the RBI. But if you want to create wealth, you are not going to put your money in debt products. For the simple calculation here, let us see that if the inflation is at 6%, okay, inflation is at 6% means if 100 rupees is costing 100 rupees today, after 1 year, it is going to lose 6% of its value. That means 100 rupees will be worth 94 after 1 year. Okay, so when you are keeping 100 rupees in debt, in a fixed deposit, which is say giving you 6%, its value will remain 100% at the end of 1 year. You are not going to lose your capital. Okay, but if you keep 100 rupees just like that, after 1 year, its value will become 94 only because of the 6% inflation. So this is why for short term, to prevent the capital erosion, we are suggesting that you take debt products. But for long term, this is not going to be beneficial. For long term, we always prefer equity products which give a much higher rate of return. Market has given an average of 12% of returns, which is double that of the inflation. So it takes care of the inflation as well, and it takes care of post-inflation tax. For passive investment, we are recommending that you stick to equity as well as gold. In equity, there are different classes which are available, like the exchange traded funds, the stocks, and the direct mutual funds. Now, the word to understand here is direct. Direct means you investing on your own by your own study, not going through an agent. Why? We'll discuss further. And exchange traded funds. Exchange traded funds are just like mutual funds, but they are bought and sold like shares. You don't need any intermediary. You don't need to do any study as well. You don't have to. This is the simplest of the investing possible, which you can start right tomorrow itself. Tomorrow, when the market is open, you can start investing in Nifty Bs, Junior Bs, and all these exchange traded funds. This is zero knowledge required for investment, and it has given excellent returns. If you want to venture into stocks directly, yes, we have some criteria. These are WealthCon criteria itself, developed by WealthCon themselves. These are criteria we'll discuss, but maybe not so much in detail today, because our focus is on passive investment and you're starting off, so we don't want to discuss too much and burden yourself too much. I'm actually speaking about this topic in the I.M.A Medicon, which is going to happen in Bangalore on 26th of October. So it will be a fantastic event, because it's going to be a comprehensive finance seminar in which direct investment in stocks and mutual funds will be discussed. So if it is possible, please to attend on 26th of October. Now, I'm not going to discuss this. We'll just take a few questions when we'll come to this. Easiest thing, what I said, the agents come to you with investment of mutual funds. So they come and say that, doctor, I will invest, I'll be your agent, I'll invest the funds on your behalf, and you manage your practice and you just give me the money funds and then I'll invest on your behalf. So that agent, when he invests, that investment is called as a regular investment. But when you invest it yourself, the investment is called as direct. Now, what is the difference between a direct and a regular fund is, in a regular fund, there is a commission which goes to the fund house. There is a commission that goes to the agent. And then after that, whatever comes to you. Now, fund house commission cannot be fund house, because they are managing it. So they will be charging some commission for themselves. So fund house commission cannot be negated. But you can negate this agent's commission and you can add that into your own by investing directly. Now you may say that the agent is saying he is going to charge only 1% of my investment. I said 1% is not a big deal here. If I'm investing 1 lakh rupees, I'm giving him 1,000 rupees. Chalta hai, 1 lakh ka profit, 1,000 is 1% of profit I'm giving him. That's okay. But this is where the compounding hits you. This is fine for an investment for one SIP or two, it's okay. But when it goes, but most of us will be investing for say 20 years or 25 years or 30 years also. The SIP is going on for that time. Now, the regular plan is always going to give you 1% lesser return than the direct plan, because this 1% is the agent's commission. Okay. So now over a period of 20 years, this 1% adds up to this amount, 17.16 lakhs for this, 18.76 lakhs for this, 24.8 lakhs So basically, you have given your agent 17 lakhs, 18 lakhs, 24 lakhs, 44 lakhs, 62 lakhs for this fund, whatever. So this is all your money, which the agent is taking for what? For doing a job which you can learn within 15 minutes by doing it yourself. And imagine this is the agent doing it to most of the doctor colleagues which you know. This is only money he's taking from you. Like that, if he has gone to 10 doctors, that means his commission alone goes to 2.4 crores. 24 lakhs from one doctor, 2.4 crores from 10 doctors. Can you imagine that? This is why the agents come to you saying, doctor, you're busy, let me handle your money. Again, not going to be discussing in detail about how this thing, but when we take the question answer sessions, definitely I'm going to touch this topic. The taxation, right now with a lot of changes in the taxation and the capital gains and things which have been touched, a lot of things have changed in the tax, but the previous thing which was there that we could use the section 80cc to save certain tax, that has all gone now. So for us, it will be better that the CS compute the tax. But what you need to know is that once you come into the investment and trading methodology, there is a way to save the tax even further and legally also. So this can happen once you learn how to do the trading as well. But currently we are sticking to investment, so let us not worry too much about it right now. Coming to the topic of insurance, most of the life insurance corporation companies, I'm not saying only LIC, but there are life insurance from every company, Aditya Birla or Reliance or even the banks are selling you policies. They are masquerading as investment cum insurance policies. Now, one thing we need to understand is that investment and insurance do not mix. Investment is to create wealth. Insurance is an expense. Insurance is an expense, so it has to be kept as expense only. It cannot be clubbed. When you club insurance and investment together, you are not going to get more than 6% of your returns, and you are paying a very hefty premium for it. So our recommendation as from Welcon is you only take a term insurance for death, which is like an insurance for the car, the premium of which has to be renewed every year. Just like that, but there's a huge difference between the premium. For example, an endowment policy of, say, typically I'm talking an endowment policy with a coverage of 20 lakh as the death benefit, okay, will have an annual premium which is close to around 70,000. Okay, this will be the annual premium which is about 70,000, and it is going to give you have to pay 70,000 yearly for say 25 years, and then after 25 years you're going to get back that benefit. At the most maximum you're going to get back is around 50 lakh rupees or something, which is after the policy maturity. Okay, now the term insurance typically for someone say in 30s or even in 40s, typically the term insurance will have a premium of only 35,000 annually, which is definitely less than this, and it will have a life cover of 2 crores. Now, where is 20 lakhs and where is 2 crores? This is the life cover. If something happens to this person, he's paying a premium of 70K and his life is covered only for 20 lakhs. His dependents will get only 20 lakhs. But one who has a term insurance is paying only 35,000 and getting a cover of 2 crores. At the same time, he's saving this 35,000. Now, if this 35,000 is invested as an SIP in equity, this itself is going to give in the same time frame a much bigger figure. I can show you the calculation right now online after the presentation is ended. I'll show you how much more this gives and how much more wealth you can create and how beneficial it is to have only term insurance and close off all your health insurance policies. The other insurance which one must have is health insurance. Health insurance is mandatory. Car insurance and everything, of course, we get it done, but we ourselves, many of our doctors don't have health insurance. So for health and for life, there are only two insurance. One health insurance, which should be individual and it should not be like a family floater plan. Health insurance and term insurance for life for the earning member of the family is definitely a requirement. No other insurance come investment policy should be entertained. Now, when you come to term insurance, it should be 20 times annual expenses or loan or 2 crores, whichever is higher. Now, minimum we are saying 2 crores, but many of us have expenses which are much more than that. So we calculate your annual expenses multiplied by 20 plus the loan liabilities which you have. That should be the amount of sum assured. And we are taking the term insurance only up till the age of maximum 70 years, because by the time you're 70, all your children, they would have started earning on their own and they do not require any kind of financial support from you. The idea of having a term insurance is during the peak earning period, if something happens to the person who's running the family, their children or their family should not suffer. So that is why we are saying that term insurance should only be at till the age of 70. And there is also an ethical reason here. It's a slightly tricky one, and maybe it can be considered in a wrong light, but still I would like to say that if you have many companies, they sell this term insurance till the age of 100. It's not required. Because what happens is, say, if you reach the age of 80, 85 and you're frail and you're lying on the bed, nobody will take care of you because they want you to die. Because then you're worth 2 crores or you're worth 5 crores or whatever it is. I'm sorry, I'm being harsh here, but things have happened. So, and sorry, we'll take the question answer, sir, at the end. So the term, the payment, many of the times what happens is these term companies, they say that you can pay the premium only for the 5 years and then no premium at all. But then in such cases, the premiums are very high. Choose to pay the term until the choose to pay annually until the end of the term. This saves you a lot of money. You may, when we come to the details of calculation, you'll see that this saves you a lot more money. Term insurances are available easily from all these companies, LIC, SBI, HDFC, ICICI, but none of them will sell you directly. You have to ask for it. They will only sell you endowment policies like or unit-linked insurance plans, but they will never sell you these term insurances directly because they do not have that much commission out of it. Loan is the modern slavery. Loan-free life is bliss currently. So now there are two types of loans: good loan and bad loan. Good loan is something which you are using it for your purpose and which will create more assets. Like if you're building a home appreciates, the real estate appreciates. That's fine. That's a good loan. Or you're taking a loan for education, which in turn, or a hospital which you are building and which gives you a month-on-month earning. Those are all good loans. So bad loans are consumer loans, like loans taken for appliances or loans taken for the car, the value of which is going to go down. And credit cards, like you start using credit cards and then you don't suddenly you see that you utilize the hell of credit card limit and then you don't have money to pay back, so then you convert that into EMI, so it automatically becomes a loan and it becomes a huge loan. The rate of interest charged for credit card delayed payment is up to 18%, 25%, 30%, depends on what card which you're using. So those are called as bad loans. But direct comparison to them, it's like bad terrorist or good terrorist. A terrorist is a terrorist. So a loan is a loan, whether good or bad. So you clear off your loan as early as possible. Loan-free life is bliss. So if it is mandatory that you have to take loan, then take the smallest amount possible for the shortest duration with the lowest interest rate. You can actually negotiate the interest rate with the banks. The bargaining should be done for a loan interest. Do not consider that if you bargain for the loan interest, it will make you any inferior. You can actually do the bargaining and get a better loan of interest. For credit cards, many of us are using credit cards, but there are rules which we need to follow for credit cards, because the loan amount on credit card is very high, much higher than a personal loan as well. So if you are using credit card, use it legibly and clear off the bill before the due date. If you have the habit of not clearing of the bill on due date, please do not use a credit card. The banks will come to you saying, "Oh, your CIBIL score is good, we're going to give you the credit card." But no, CIBIL score is just for polishing your ego. I have a very good CIBIL score. What's the use of a CIBIL score? Even if you have a very good CIBIL score and do not have any proper ITR, the bank is not going to give you any loans or credit cards or any of these stuffs. But even if you have a very low CIBIL score and your IT returns are very good, they will fall behind you to take their cards and take their products and all those things. So don't worry too much about the CIBIL score. As we go through our life stages, we have most of our basic graduation, undergraduation, fellowships. All it takes about 30 years. Till then, we don't earn. Our earning only starts after we find a job, after we finished all those things. And this is when immediately we should start thinking about wealth creation, because the more actively you're earning, the more chances of you to get the money diversified, properly invested, and create wealth. After the age of 60, your capital should not be wealth creation, because by the time you had already created the wealth, taken the risk, invested in equity and all those things, and then made some wealth. But after the age of 60, the goal should be wealth protection. Whatever wealth you have made till now, protect that and earn from that. So that is where you should be dividing your investment more into the debt side. The simple formula which we use is in investment is 100 minus the age. So if someone is say 45, so 100 minus 45 becomes 55. So that means 55% of your active earning should go into investing into equity, and 45% should go into debt. Now, this is just a guideline, not a hardline rule to be followed. If you have a good risk-taking capacity, you can even do investing after the age of 60. It depends on personal choice, but it is just a guideline. So, financial planning, as when we are earning, we have to divide our spendings into whatever is required for a monthly basis, like which go into the living expenses, taxes or insurance or EMIs or school fees, and then whatever is remaining from the savings, we are going to put it for investment. In this, when we are investing in equity, we are sure that we are not going to touch the money which is marked for these things: tax, insurance, EMIs or school fees, because these are necessary expenses which have to be paid. Only after you have subtracted these from your living expenses, from your earning, whatever is remaining, you are going to put it for investment. In the more detailed calculation, when we discuss more detail about calculation, not today, of course, we can also start using the formula for compounded annualized growth of, CAGR formula, which is called compounded annual growth of returns. So based on that formula, even right now today, we can know that how much of a fund is required after certain time, like after 10 years, how much of funds you require for a particular thing, like your child's marriage or child's education a foreign degree, if you want to send your child to the foreign. So based on current earning and based on current inflation, how much money would I be requiring for this purpose? That you can calculate even right now and plan for creating that much of wealth. So this all thing goes in the financial planning. At the same time, you have to plan for your retirement as well. There will come a time when you don't want to work any longer, or you don't have the capacity to work that much. So at that time, whatever wealth you've created, whatever passive earning which you have made, that is going to give you your further earnings. The take-home message for today is to be self-reliant and start learning finances. Those people who have already been investing since years and they are doing good, well and good, no problem. But there is no harm in learning it again from our expert, Sir Dr. Ramnath Guthe. We all have been taught by him very well. So, and those people who have joined for the first time or they want to learn finances, the world has just opened up for you. I will tell you how to go about in future in further learnings. But the thing is, you need to take an action right now. Open up Demat accounts. There are so many brokers available who are giving you free brokerage service. So, and whatever plans you have, whatever endowment plans, whatever the policies which have been sold to you, please close all those policies. Get a term insurance. Get a term insurance first. Once the term insurance is activated, close off all the policies. Take the loss, no problem. But in the long run, that is going to be much more beneficial for you. The journey to the financial freedom has just started. For those who have, as I mentioned, and everybody, whoever is attending today, you can all join the WealthCon India platform on Telegram. Okay, download Telegram and you can take down my number. I will write it in the chat box. This is my number, 98455091184. This is my number. You can send a message to me on Telegram and I will add you to the WealthCon's Telegram group through which the continued learning can happen. More and more knowledge you can get, not only from me, but much more expert investors and investors who are, you can get knowledge from them. And trust me, all of them are doing very well in their own field. They have their big hospitals and they're working on their own terms and all those things. You will learn a lot. You will learn a lot in finances. And you will never be losing out on your primary job. That is being a doctor, what you love. You will never be losing out on that. That's for sure. So I think we can take question answers now, sir, if you have time. It's already 9:30. Don't mind, we can take question answers.
Thank you, Dr. Shirish Narsapur. It was a wonderful presentation. More than 100 people joined in this Zoom, and so also in the OrthoTV also many doctors have joined. I am sorry for the people who could not join because it is limited to 100. Those who wants to ask questions can raise hand so that they can unmute themselves and ask question. Dr. Virajipur Lingadevaru Nandesh, please ask your question, sir.
Sir, my question is, sir, it's a notion that we buy cars on loan so that we get depreciation as well as paying depreciation so that the tax amount will come down. Is it true? And also you get on whatever interest you pay, it's exempted from tax. What's your opinion about that?
Sir, this is how we are all missold the things, because when you buy a car of 10 lakh rupees, that means you have to give 10 lakh rupees to buy the car. For you to earn 10 lakh rupees, you should have already paid 30% tax. So your 10 lakh is after you have earned 30% more, that is 13 lakhs. For you to pay 10 lakhs, you would have earned 13 lakhs.
True.
Goes to the government as tax, and then you are taking a car worth 10 lakh rupees. So basically, you are paying 13 lakhs for that car.
True.
And that person who is selling you the car, he's again paying GST or whatever it is. So that person is also going to pay the tax to the government, whatever 30%. So for him, the car is costing only 7 lakh rupees. Now you earned 13 lakhs, you paid 10 lakhs. That guy took 10 lakhs, he got 7 lakhs, and government has earned 6 lakh rupees from this transaction. Now for this 10 lakh, if you take loan again, you are paying that extra additional interest. You already paid 33 lakh rupees tax. That tax is not going to be saved. So whatever extra interest you're taking, that is that you're trying to reduce by the further tax which you're going to pay on that car. So it is a waste of an exercise to say that it is this thing. That's why, I mean, if the car has become old and you're churning it, that is okay. But for the purpose of saving tax, it is not going to be fruitful in the long run.
What is your thoughts about the impending recession?
Sir?
What are your thoughts about the impending recession, global recession, which they are planning to declare soon?
See, what happens is the market goes in cycles, always up and down. As we saw that 2008 was a recession, and 2008 also our Indian market did not take such a big hit as much as the US markets had. Now recently in August first week as well, there was a global sell-off and markets all over the world crashed because of the yen carry trade. The Japanese Bank of Japan situation, because they raised their interest rates and all those things. It affected markets world over. But we saw that markets world over fell in almost 10% or 12% in that range. But India market, that is Nifty, it corrected only about 5 to 6%. Compared to other markets, Indian markets are very much resilient. The reason being that there are a lot of domestic institutional investors, domestic institutional players, and the government of India, which via their public sector units is investing. Plus, there are lots of retailers in India, which is not the case in many of the markets across the world. So even if the recession happens, we look at it as an opportunity to buy more. So whenever there is a market crash, those who are investing should be adding more, because and this goes true for adding in index, the exchange traded funds which are talked about, the Nifty Bs and the Junior Bs. Index is one thing which will never become zero. Supposing if you have any particular company share and the company goes down, you may lose your money which you have put in that company. But if you invest in the index, that is Nifty or what you call the National Stock Exchange, if you invest directly into Nifty, your money will never go down, because Nifty is the barometer of Indian economy. Whichever be the government in the center, whichever party government is there in the center, it will never see to it that Indian economy will be at the losing end. Plus, the mutual fund business is 65 lakh crore rupees worth, the mutual fund business. And there are so many biggies like Ambani's or Adani's or Tata's with a combined worth of billions of dollars. They have also invested into this Indian market. So they will never see that their own worth will become zero. So this is never going to happen. Nifty is never going to become zero.
Because many of my friends have lost too much of money in mutual funds. And one more thing is the Bitcoins. So they are very risky.
We are not discussing Bitcoin at all, because Bitcoins are unregulated.
Okay.
In Bitcoin, 1 rupee can become 1 crore and 1 crore rupee can become zero within a fraction of a second. So Bitcoins are unregulated. We don't invest in Bitcoins at all. We invest only in index.
I believe in investing in my friends and relatives because whatever is it is good karma for me. And investing in a company which is far off, who doesn't care about me, who doesn't know about me, is my funda. What do you think about it?
You mean to say that trusting other companies?
No, my friends and relatives in their business and their needs. So, how much of I mean, I've had bad experiences wherein somebody has not paid me back and all, but still I believe that is better than investing in a company or like Ambani, Adani who don't care about me and who don't have any values and ethics.
That's what that's what I think. We are talking about investing in index, investing directly in the barometer of the Indian economy.
Okay, that's a good way.
Sir, Dr. Chiniwala is there. Sir, please ask your question.
Yes. Hello, Dr. Shirish.
Yes, sir.
I'm Dr. Chiniwala.
Hello, sir.
Gangavati.
Your mother's
Classmate of your mother.
I know, sir.
Just I wanted to know that if we want to construct a hospital or home, anything, at that time, is it better to go for loan with any of the nationalized banks? Because the interest forever, whichever you want to invest directly now, it is very difficult with close together amount in a hospital or home. So whether it is good to go with any nationalized banks for loan repayment.
Yes, sir. A hospital, yeah, we consider it as a good loan. As I mentioned, that the good loan and bad loan. If it's possible for you to build it without loan, nothing like it. But if you have to take loan for hospital, you can definitely take loan, whatever is the minimal amount possible. And try to clear off the loan as early as possible. Whatever extra additional income which you are getting from the hospital or anything, just try to clear off the principal.
Okay. But in the NCLA, they will tell that's 6.8 or 7 percentage. So later on, hiding this one will be there, then they will rise up to 9%.
That is because of floating interest rate.
Floating interest.
That is because of the floating interest rate that the RBI. But if you take a fixed interest rate, already the interest rate will be very high.
So floating interest is better than this one fixed.
Interest is better than this thing because then automatically what happens is if you are taking floating interest, your whatever FDs if you have kept or anything, even those returns, the returns on FD are also increasing in proportion to that. So always keep a floating interest rate only, sir.
So what about your idea of keeping the fixed deposits?
So fixed deposits are good for short term. Like if you want to protect your capital for a couple of years, 1 year, 2 year, definitely keep it in fixed deposit. Do not invest in equity. There is a chance that equity might give you phenomenal returns in these 1 or 2 years. But there is also a chance on the other hand that in these 1 or 2 years if the market is staying lateral or the market is down, you may not make any money out of it. But in the debt funds, in the like fixed deposit, you are assured that at least your capital will be protected. Even though the returns may not be very high, but your capital will be protected.
So now between this fixed deposits and mutual funds, which one is better?
Sir, what the goal is short term or long term?
Short term.
Short term fixed deposits only, sir.
Okay. Long term means.
Long term means you can invest in mutual funds or in.
Yes, we are not so familiar with this mutual
ups and downs.
We can't follow it properly. At the time, what happens? We have to go through the agents only.
No, that is not, sir. We are here to. We all are here now. The idea of today's seminar is to make you adapt whatever control you want to take on your own finances, you will be able to take it, sir. And it's not that you consider that, okay, I am already 50 or 55. No, but we have people, doctors joining in WealthCon on a daily basis who are well above 65, 70 also. They're coming, they're learning finances, they're looking at it as some new learning.
Yeah, because we already crossed 70.
Dr. Nilofer Khan, you may ask your question.
Thank you, Shirish.
Yes, sir. Yes.
Nice.
Hello. Good evening, sir.
Yes, madam.
Yeah, I would like to ask my son, who is around 29-year-old, he started paying LIC, sir. It is around 2.5 lakhs per year. He must pay it for 15 years. He is paying since 4 years. After listening to your discussion, I felt I will advise him to stop that and invest in mutual funds or SIP or any other thing. Can you please explain me why should I stop LIC, sir?
Yes, for that, I'll just share the screen again and I'll show you.
Yes, sir.
Can you see my screen now?
115.
Yes, sir.
Have it.
Yes, yes, yes,
So, madam, you are saying that your son is paying 2.5 lakhs, right?
yes,
On a yearly basis.
yes,
That comes up to roughly around 20,000 rupees per month.
yes,
Okay. Now you're saying he is paying 2,50,000 rupees per year for 15
yes.
16.
Yes, sir.
Okay, so let this be interactive so that this question will answer the queries of a lot of people. There are questions which has been asked about you, whether that is going to be beneficial from mutual funds and all those things. All those questions will be answered in this answer alone. So now
Yes,
you are saying that he is paying 2,50,000.
yes, sir.
Okay, and he is going to pay it for 15 years.
Yes,
So that means he is going to pay a net amount of 37,50,000 rupees over a period of 15 years.
yes.
And how much is he going to get back after the policy matures?
Around 64 lakhs, sir.
Okay, madam. 64 lakhs he is going to get back, right?
Yes,
So he has put in 37,50,000 and get
two
back
times, sir.
4 lakhs.
Okay, sir.
Okay, so this is So this is going to be a net returns of this divided by this. So minus 1 to 7.
Correct question 1,15,000 पे करते 16 years तक पे करते इतना amount है 16 years को.
He has paid 37,50,000 and he is going to get back 64 lakhs, which is roughly, you can say, not even double.
Okay.
Not even double, right? And this is after the age of, after how many years?
15 years.
No, he is going to get back 64 lakhs after 15 years.
No, 1 minute, sir. It is twice the amount, 1 crore 28,000, sir. Sorry for the misunderstanding.
1 crore
Yes.
8 lakhs. At what age is he going to get it?
Around 50, sir.
Around the age of 50.
Yes.
He is right now
30.
He is right now 30. So after 20 years, right?
Yes. Yes.
For 28 lakhs, he's put in 37,50,000, right? Okay, now we'll do the same thing. 20,000 of SIP.
Okay.
Okay, for a period of 20 years.
Okay.
Okay, I'm putting same amount what your son is paying.
Okay.
For a of 20 years with a minimal expected rate of return from the market, which is 12%. Nifty has historically given you more than 12% only, but we are taking a lower side, 12%.
Okay.
You can see that he is getting 1 crore 99 lakhs, which is 2 crores roughly.
Okay.
Okay, he is roughly getting 2 crore rupees in the same time frame.
Okay, sir.
Here in LIC, he has got only 1 crore 28 lakhs. Okay. Now,
Okay.
we have to change a little further and we see how better we can invest from here. Okay. This
Okay.
2,000 he has invested. Okay. This is going to give him a rate of return of roughly only 6 to 8% only by this time. And
Okay.
this he is going to get a life cover of only around 20 lakh rupees.
Okay.
But if he say puts that 20,000 rupees per month here, even if he reduces that to say 15,000, okay?
Okay.
Even if he say reduces that to 15,000, he's still making 1 crore 49 lakhs, which is 20 lakhs more than the LIC.
Okay.
Plus this 5,000 what he's saving, he can use that and he can take a term insurance which is going to give him a life cover of 2 crore rupees.
Okay.
So there is always a benefit, and this we are calculating with a base minimal expected rate of 12%. If the market gives him 15%, which is
Okay.
14%, then at the same 20,000 investment, he is going to make 2.63 crores.
Okay.
And now, in this very question, I'm going to explain how the compounding works. Now,
Okay.
you see that 14% at 20,000 rupees per month, you are investing at 14% rate of return. In the age of, for 20 years, you have made 2.63 crores.
Okay.
Now, what do you think is the expected value here in this column? Okay.
Okay.
In this, what will be the expected value if he continues for another 5 years? Anybody? For the next 5 years only. Now look at how the figures are increasing. How much was it at the age of 20? At the age of 50? Now your son, we are talking about your son at the age of 50. He is having 2.63 crores. But in the next 5 years, if he continues, that thing has nearly doubled. And in the next 5 years, he continues at the age of 60. Look at the figure which is going up. It is going up to 11 crores. This is the power of compounding, because every time, every year, whatever money you are getting, now the first investment is going to increase by 14%. So 100 rupees has become 114. Now the next year, this entire 114 becomes your lump sum, and the 114 grows to 14%.
Okay.
So that is how the compounding plays. So the longer the game, the more the wealth you can create.
Okay.
Inflation that time.
Thank you, sir.
And
Dr.
yes.
You can continue, madam.
Yeah. After 20 years, he can switch over to SWP, sir. Now he was doing SIP. Will he get monthly income?
Yes,
And
madam.
also his corpus will increase.
Yeah, that's what. Once the corpus has increased, you can start doing the systematic withdrawal plan as well.
Okay.
Dr. Girish Kulkarni, you can unmute and ask your question.
Good evening, Dr. Shirish. It was a very highly appreciable and knowledgeable talk. I think we can add two more things. One is building an emergency corpus of around probably 6 months to 1 year to unforeseen loss of income and disability. One insurance, we can plan for that also if we are in corporate setup. And second thing is, I think as we are becoming knowledgeable, our spouse also should be made aware about all these things. Because during COVID, we went through my in-law death and we faced so many things, that transfer of the property, money and other things. That is a hell of problem we will face once we face. I think these two also as youngsters, we should start incorporating in our family. That will help all of us. Thank you.
Yes, sir. That is true. That is true. Sir, there is one question which says from Sandeep sir. It says an agent I connected said he would charge average 0.5% commission. Is it worth paying this commission as his mutual funds would be better reliable than me? So Sandeep sir, can I ask how old are you?
Hello, doctor. Sir, I'm 40 years old.
Sir, okay. So consider that again. Can I share the screen here again? Okay, sir. Okay, consider that your agent is how much are you planning to invest anyway monthly?
Actually, there is a lump sum that I have, which is close to 1 crore.
Okay, sir.
And
so
that is why I don't have the confidence of investing with my own selection.
Okay, so the total investment of 1 CR. Okay, suppose you plan to invest for how many years? You said
for at least 10 years, and then maybe start a withdrawal plan.
Okay, for 10 years. So suppose your mutual fund agent gives you what do you call 15% interest. Okay. 15, he's saying 15, if he gives you 15% interest, right? I'm just saying, supposing. So you are going to get a total value of 4 crore 45 lakhs, something change. Okay. But if you do it yourself, you can get that additional 5%. Okay. In 10 years, it may not look like a very big difference. In 10 years, it may not look like a very big difference. See, 4 crores and 4 lakhs here. But if you get that additional 0.5%, it jumps to 17 lakhs extra to you. Now, this is where the difference comes if you keep it increased for a few more period, like say for a period of 20 years. So you're getting 17.85 crores, but when you're doing it with an agent, it goes down to 1 crore less. The longer you keep, the more the money your agent is making. He will say 0.5%, but that 0.5% is not on your 0.5% which is invested. It is on the entire money which that fund is making. If you say that you're not confident enough of making 15%, I think you should just come and check how to invest in ETFs. A lot of discussion of that keeps happening in our WealthCon groups. The ETFs have given in excess of almost 16 to 17% returns. Investment in ETFs alone. You don't have to worry about the funds. And none of the fund managers have beaten the index properly.
Okay.
Thank you, sir.
Okay,
I request Dr. Chinivalar to ask his question.
Oh, my both.
Dr. Chinivalar, please unmute yourself and ask.
1.5 पे करते हैं. This is actual figure, sir. 1.5 एक पॉलिसी. दोनों को 2.30. तो साजिद 2.30, साद 2.30 पे करते हैं.
Sorry, you're not audible properly. I couldn't hear a question.
16 years.
Dr. Chinivalar.
That is 18.40 you are paying. 9 years तक तुम्हें क्या भी पे करने की जरूरत नहीं.
Okay, I request Dr. Pavana to ask the question.
25 years, 25th year, he will give you this each policy keeper. 2 lakhs. Yes, sir. 36, 80. 36 lakh 80,000.
No, sir. How do you assess our
8 lakhs.
IMA individual doctor protection scheme, that investment scheme is there in IMA? In financial, how do you assess that? What is
the IMA death benefit you meant to say, sir? IMA
family benefits.
Family benefit.
That is good enough. That is good enough. As an additional this thing, it definitely, I think it should be, it's a very good initiative actually from IMA to have that.
Okay.
Looking after our own people.
Yes. Dr.
Yeah, Dr. Pavana here. Can
yes, ma'am.
Pavana, yes. Please wait a second. Dr. Chinivalar.
Yes, sir. Sure.
Okay.
Hello, Dr. Shirish.
Yes, sir.
Actually, our IMA has started a social security scheme. I think you might have come to know, or I don't know. It is a very good scheme. Only thing, after their death, the family is going to get nearly, in the last few years, we have paid up to 90 to 95 lakhs to the family.
Yes, sir.
If they have become members for both this one schemes. Yeah. That is old scheme as well as Silver Jubilee scheme. And apart from that one, we have 6 years back, we started one health scheme for our own IMA members also, with a very minimum premium amount and giving up to 2 lakhs per this one, up to the 2 lakhs, the tune of this one. And wherever throughout India, they can take a treatment anywhere in India. And the only thing they have to submit the claims. So that is also started 6 years back, and it's doing good. So almost by this time, we have reimbursed more than 2.5 to 3 crores to our own people.
That is lovely, sir. That is lovely.
Thank you, sir. Dr. Pavana, you can ask your question.
Yeah. Good evening, Dr. Shirish. It was a very amazing presentation. So I just have 2 queries here. So
Yes.
would you, what is your take on sovereign gold bond between physical gold to this?
Yes,
Which
ma'am.
is a better investment?
Ma'am, gold SGBs and gold Bs are much better investment as compared to physical gold.
Okay.
Because physical gold in the form of jewelry is not going to be of much benefit, because as I mentioned, there'll be a lot of making charges and wastage charges which apply. While investing in SGB and gold Bs is literally like investing in gold itself. Whatever earning you are getting in that, it is following the gold market. And when you suppose decide to buy some gold jewelry out of it, you can always sell that and then buy the gold.
Okay. So one more question I have. When do we know that what should be the corpus when we invest in an SIP to convert into the SWP? Is the age limit is what we have to take, or the corpus amount what you have to take?
There should always be an exit plan for every investment which you have started. Now the exit plans are either time targets or price targets. Now, suppose if I start with some investment saying I have invested 10 lakh rupees and I want it to become 20 lakh rupees. Now it can become 20 lakh within 1 year also, within 2 years also, within 10 years also. It may take 15 years also. We don't know, because how my investment is going, I don't know. Suppose if that 10 lakh has become 20 lakh, my price target has achieved, then I exit it immaterial of whether I feel it or not, whether I want to keep it for some more time. Because many times what happens is, if I put 10 lakhs and I say, oh, no, I want it to become double 20 lakhs, and the market has really given me good profits, within 1 year only it will become 20 lakhs. I have to remove it at that time. Why? Because I have to control my mind. Then at that time, I should not get a greed. Oh no, it has given 20 lakhs. Next 1 month, I think next 1 year, it may give 40 lakhs. What if you keep it for another 1 year and then the market goes down a little bit and the value of your 10 lakh becomes only 5 lakh rupees? Then you lose the chance of booking the profit when there was time. So always stick to your targets. Second thing is time target. Time target is, now I'm going to put 10 lakh rupees and I am going to wait for 7 years and then I'm going to withdraw whatever be the profit. Here, I want to make a point that when you're investing, you should never exit your investment in loss. When there is a time target, there is always a risk that your investment may not have been in positive. Like if I have a time target of 3 years or 4 years and your investment of 10 lakh has given you only 9 lakh rupees its value, then you are not going to close that investment in loss. You are going to hold it for at that time you check what the situation is, and you understand why the loss is happening, whether the company which you have invested is doing good or not. But this generally does not happen if you have invested in index. Because the advantage of investing in index is a group of companies. Like now Nifty 50 means the top 50 performing companies of India will be constituting of the Nifty 50. When you are investing in Nifty 50, your money is distributed into those 50 companies. Now what happens is, sometimes one of the companies may not be performing well. So that company is thrown out of the 50, and then the company which is performing from the next batch is taken into that group. So your money stays with the top 50 companies, immaterial of which company there are in the top 50. So that is why when you're investing in ETFs, this kind of risk does not happen. And over a period of 7 years, which is the minimum time frame recommended, you will never be making a loss.
Okay. Okay.
Thank you, sir.
Thank you, sir.
I request Dr. Anuradha Parmesh to unmute and ask the question. Anuradha Parmesh, you're there.
Yeah, good evening. Sincere thanks to KSB and Dr. Rajendra Prasad for exposing our fraternity to our professional colleague amidst his orthopedic surgery. He is really invested time and started in not only investing, also he is now helping other doctors, professional colleagues to know about what is how you have to divert your money. Well, Dr. Shirish, I'm extremely sorry to say that none of us have been guided properly at all. I'm into my 40th year of practice, and I have opened my eyes maybe for the past 5 to 6 years. And since I'm already 64, I know fully well that I have some limitations, but certainly I have a message for each and every professional colleague of mine. Whomever I bump into, I tell them, you earn 5,000, make sure you divide that money and invest properly. So I will request our KSB to utilize services of Dr. Shirish and create a panel of consultants where Dr. Shirish is going to head, and he is going to guide us all. It's not for our senior citizens like us. I mean, you need to tell us also, because here also at this age also, we have some investment options, and definitely there are some limitations. And Dr. Shirish, whatever you spoke, I could understand each and every word of it. Gold investment, I think you need to add one more sentence. It's not just a wastage. It's not just a making charge. They dupe you with the carat. They tell you it's 22 carat and it is 21. Forget about 21. It is 20.2 carat. So even in the this thing, quality of gold and silver that we buy, we are getting duped. So you need to add one more sentence to that. Whichever jeweler you go to, you're going to be duped. But you have a handful of jewelers who stick to that. And I know who they are, and I utilize their services. So that way, you spoke about investing in jewelry, investing everything, every investment that you spoke about. I could understand what you are trying to tell, what is equity, etc., etc. So the reason I'm speaking is I want to thank KSB and Rajendra Prasad as well as Dr. Shirish for exposing all of us into this. Wish more and more doctors get into this and see that the youngsters, they become richer than us, not just in money wise, in all round. I want them to be rich. I would like to see our professional colleagues being richer. And that's the reason, Prasad, I thought I need to speak. I need to tell that all that he spoke does make sense, but do the investment in small quantities if you're not sure, if you're still young. If you're much older, you need to study and then take a decision. That's what I wanted to say. Thanks for allowing me to say a few words.
Thank you, madam. Thank you. I request Dr. Prasad Patil to ask his question.
Yes, sir. Hello, sir. Good evening. Well, if I'm a wife of Dr. Patil. Yeah. Actually, he went to hospital. So I am also doctor pathologist. So my question is like, you said like closing the LIC life insurance policies. So like, I have heard that like Japan, in countries like Japan, so there's a zero interest. So I don't know about the future of Indian market. So whether they're going to interest, like they're going to keep it or not, don't know. At that time, these insurances, they have a value, right?
Yeah.
So what is your opinion in this regard?
Oh, it's actually a very good question which you asked, madam, because just first week of August, there was a market crash. This happened because Bank of Japan raised interest by 0.5%.
Yes.
Not very high, but very 0.5%. It's a very interesting situation. Why this happened? Because the countries, the currency exchange, what do you call that now? The USD is 83 rupees. $1 is 83 rupees. Until all these things they come into macroeconomics. Now, what was happening is because the Japan bank was giving nearly 0
Yes,
Near
sir.
0% interest of loan, what people used to take from Bank of Japan, invest in US bonds, which used to give them 6-7% interest. And because the US and the USD and the yen, the difference was pretty high, they were making money on that spread as well.
Yes, sir.
Now, what happened is, as soon as Japan raised the interest, the value of yen appreciated with respect to dollar. That means the yen became a little costlier than the dollar, not completely, but comparatively, that whatever rate it was, it became a little costlier than the dollar. Now, for them, they were not able to pay back this extra increased rate because the yen also became costlier and the interest in Japan also became costlier. So they started dumping the money out and booking the profit of whatever money they'd taken from yen, and then they started booking the profits. And as soon as the profit booking started in US, the market started crashing.
Yes, sir.
To prevent this, RBI always has managed to up their interest rate when US has done that. This is so that the USD and the INR spread always keeps to a bare minimum. There is not a very severe rise or fall in USD INR. So when US raises its rates, RBI also raises the interest rates. US reduces the interest rate, RBI also reduces the interest rate. And this is the main reason when the Japan economy, as you said, that they had not kept the interest rate very high. That was the main reason why the Japan economy was stagnant for the last 2.5 decades. The Japan economy was totally stagnant. So it will never happen in India because India is a growing economy, and if any of the economic person they comes and they start reducing the interest rate, they are going to kill the economy. That is never going to happen.
Okay. Okay. Well, thank you for the clarification.
Thank you, madam. I think
there was one question which said that these direct facilities are available in Zerodha. Yes, Zerodha, Angel One, all these are no service brokers. The account is very easy to open with them. Zerodha or Angel One, anyone can open that and start investing in Nifty Bs. These are the names of the exchange traded funds which I was talking about. The Nifty Bs, Junior Nifty Bs. So when you invest in Nifty, you are actually investing in the top 50, the next 100 companies, and the next 150 companies. So if you invest in these three, Nifty Bs, Junior Bs, Mid 150 Bs, you don't have to invest in any mutual funds or any shares directly. You're basically investing your money in the top 250 companies of India. Add to that your money in gold Bs and silver Bs, and you are diversified into gold and silver as well. So your money has gone into top 250 companies of India, which have been listed on the exchange, plus the gold and silver. So you suppose if you want to start with your SIP, plain and simple, if you have to spare 1 lakh rupees of cash every month, invest in the ratio to begin with 4-3-2-1, that is 40,000. You can start with 30,000 here in Nifty Bs, 25,000 in Junior Bs, that makes it 55, and say 20,000 in Mid 150 Bs, and or 10,000 in gold Bs and 10,000 in silver Bs. That's the total is coming up to how much? Total is 95,000. So you can maybe increase here 35 and that's a sum total of 1 lakh rupees. So you can divide your 1 lakh rupees into like this: 35,000 in Nifty Bs, 25,000 in Junior Bs, 20,000 in Mid 150 Bs, gold Bs 10,000, silver Bs 10,000. You have diversified into the top 250 companies plus gold and silver. This should give you close to 14 to 15% per annum returns.
thank you, sir.
So that is which I'm going to give in this seminar. No more tips.
Dr. Lingadevaru, you can ask your questions.
Yes.
Sir, Doctor, thank you very much for educating us, sir. We need several of this. I thank the organizers for this. Sir, there is one more loan where a luxury car costing 75 lakhs, and we are paying 80,000 per month. For about 1 year, we are paying 10 lakhs. And for 5 years, if you pay, you will be paying 50 lakhs. And if you have to keep the car, you have to pay 39 lakhs extra, or else they will take the car away. So you'd enjoy it for 5 years. And also you get income tax benefit of about 10 lakhs per year. So what do you say about this plan?
Nothing, sir. So all these plans, none of the plans are going to be in your benefit. If anybody is coming to you with some kind of plans or policies or anything, just remember one thing, that they just want to take your money from you. That's it. So no plans, no policies, nothing will work. It will only serve a purpose of, say, you might feel that you have driven some luxury car. It might just make you feel good or something. That's it. That the purpose is only that. But investment wise, it is definitely not a recommended decision.
And what about the tax amount you save, about 10 lakhs? That is not be of any help, is it? It is not in the in the calculation. We are not benefited.
When we sit for the calculation, we'll see that we are losing more.
Okay. Okay, sir. Okay, sir. It's all probably it's like a marine. The benefit is in the mirror, I think.
Yeah, double package. They're called a double package.
Understood, sir. Understood. And we are ignorant for the past 60 years. I'm a senior citizen. I don't know. Thank you, sir. Thank you.
Yes,
Dr. Prashant Mallapur, he wants to know about children's education, which is these things. Sir, you can unmute yourself and ask question.
Sir, good day, sir.
Yes, sir.
Sir, I am 32 years old, sir. I am doing MS Aftal in Kim's, sir, as a in-service PG.
Yes,
so
sir.
I want to know investment plans for my kid, sir. He's around 2.5 years old, sir.
Yes, sir.
So I want to invest for his education, sir. After 18 years and all this, for the education purpose, I want to invest something for him, sir. So what is advice for him, sir?
Sir, the best thing is your kid is very small right now.
Sir?
The best thing is your kid is very small.
Yes, sir.
If you start investing for him, definitely on his name, he cannot start investing on his this thing.
Yes, sir.
Okay. So, but you can do one thing is, you can start an investment on his name. Maybe an SIP of sort, say whatever amount you can spare, like 10,000, 20,000, whatever it is. So
yes, sir.
We start with an SIP of minimal, even if you say 10,000 rupees.
Yes, sir.
Okay, put it in the same index ETF basket only. Take Nifty B's, Junior B's in that this thing. And since your son is only 22 years old, so by the time he's 30, it would be like a 28-year-old investment, 28-year investment.
Yes, sir.
By the time he's 30, even if we expect a decent rate of 15%, he will be having a corpus of almost 5.2 crores by the time he's 30-year-old.
Sir, are you advising in particular in mid cap or small cap or like
diversify across all the all the caps. Diversify across all caps: mid cap, small cap, micro cap, and large cap. Everything. So when you invest in Nifty and mid 150Bs, you're taking care of everything. You're taking care of cap, you're taking care of mid cap, small cap, micro cap, everything.
Yes, sir. Thank you, sir. Thank you.
And there is one formula. It is called as apron equation. I'll just share this formula screen here. So with this, can you see the Excel sheet?
No, sir.
No, sir. No, cannot.
Yeah.
Yes, sir.
There's this formula where, can you see this formula? A is equal to P plus R% raised to N. This is raised to N.
Yes, sir.
So I'll just write that formula here. It is amount is equal to principal into bracket 1 plus R% raised to N, wherein the P is the principal with which you are beginning and the R is the rate of interest, that is 12% or 15% or whatever it is, and N is the number of years which you are going to hold the interest for.
Yes, sir.
I'm sorry, there was a disturbance in the line. So if you want to know what amount you want to have at the end, say after 10 years, you can just use this equation in Excel very easily and then know how much of amount you can grow with the current principal which you have. In reverse, you can also start with an end amount which you're in your mind and see what principal amount you need to keep invested. All it needs is a transfer of equation on one side to the other side. So now you already know what the amount is, you need to know what the principal is. So it becomes P is equal to A upon into bracket 1 plus R raised to N. That's it. With simple Excel equation, you can calculate how much of principal you need now to create the amount which you have in mind at the end. The thing is, I cannot show you everything right now because it becomes too difficult and too overloaded. But I'm confident that if you join the Telegram channel on WealthCon Telegram groups, more and more ideas will come to you, and you'll see how easy it is to understand and to create the wealth which you have aimed for.
Yes, sir. Yes, sir. Thanks for your advice, sir.
I think we have come to the end of it. There are no more questions. Can I ask Dr. Chinivalar to do the concluding remarks? Are there any questions other than that? So that Dr. Chinivalar can talk last.
Hello.
Yes, sir. You can give the concluding remarks, sir.
Before that one, just I want to ask one more question.
Yes,
So, Shirish, what are the mutual benefit funds options for elderly people above 60 years and where they can get fixed income and also get lump sum at maturity?
Sir, investment in equity, there is nothing called as maturity. When you are investing in a fixed funds like fixed deposit or recurring deposit, there is a maturity age, maturity date which is written. After that only you will get that much of returns. But when you're investing in equity, there is nothing called as maturity date. There is only exit plan, exit date which we have already fixed at the time when we have started the investment. So safest is to invest in ETFs, which I mentioned. ETFs is traded funds, the Nifty Bs, Junior Bs, and Mid-Market Bs.
Yeah, thank you.
All weather, all age investments. You can invest at any age in those funds.
Sir, there are no more questions. Dr. Chinivalar, you can make the concluding remarks so that we can.
Okay. Hello, Dr. Shirish.
Yes, sir.
When we started our practice almost 45 years back, these all money management schemes and were not heard of. Only we used to have LICs or fixed deposits in banks and everything. But now, so after hearing your this one speech and everything, actually we have lost a valuable years and also the money. So anyhow, thanks for your very good suggestions and kind this one for giving us very good suggestions for actually for the youngsters, those who want to invest in the future, especially after 30 years they can go ahead with such a suggestions, and they can contact you if possible.
Yes, sir.
You given your number, so directly they can contact and discuss about their investments. So thank you, Dr. Shirish, and thank you, Dr. Rajendra Prasad, for wonderful such a talk on money management. Thank you one and all those who have participated and discussed their problems and their and also thank you.
Thank you, sir. Thank you. Thanks for the opportunity.
Yes, sir.
Thank you, sir. Thank you very much. I think I can end the session. Thank you very much. Thank you, sir. I will end this.